panel on the sell-side perspective on clearing, XVA, and risk management. So pretty much wrapping up, if you like, everything we've been talking about since 2 o'clock this afternoon. If I could welcome Rohan, of course, Rohan Douglas from Quantifi, and he's moderating the panel, so he shall introduce the panelists. Rohan, good to see you, sir.
Hi, welcome. So this is a panel on sell side, and we're going to focus on clearing, liquidity, XVA. My name is Rohan Douglas. I run Quantifi. Before Quantifi, I ran emerging market and credit derivative research at Citi.
Good afternoon, everyone. My name is Ian Morris, and I run the product side of things for Commerzbank on our OTC clearing desk.
Hello, my name is Moises Gerstein. I work for ING, the Dutch financial bank institution. I am in charge of hedging and managing CBA, DBA, XVAs in general.
Hello, everyone. My name is Tushit, and I run the European risk for OTC clearing and fixed income prime brokerage within Deutsche Bank.
Okay, so we're going to have a similar kind of format to the buy side panel. We're going to ask a number of questions to the panel. We're going to discuss, and then at the end we'll have a Q&A session. We're a little bit behind, so I think we're going to compress the Q&A down to 10 minutes. Broadly speaking, the market is being transformed. It's kind of why we're here. The market has been transformed by regulations, by changes to the market. Clearing and regulations are two big parts of that. Regulations like Basel III, MiFID II, they're all having a big impact. So maybe I'll start the questions with Tushit. Have the way people trade interest rate swaps changed in response to the Basel III leverage rules?
So I think I'll just quickly begin with giving some background on the Basel III leverage rules. I think it's in response with the fact that the earlier capital model was based on RWAs, which was an internal model approved by all banks with regulators. And what regulators were really looking for is a holistic and one non-risk weighted model across, which can be applied across all banks. And they came up with the leverage ratio regime. So basically what it says is every bank needs to hold certain amount of capital based on the exposure, which is driven out of this model. So the regulation was suggested by the Basel Committee, and it's been adopted by CRR. And what it basically says is, based on the exposure, you need to hold certain amount of tier 1 capital against it. And the biggest challenge which the sell-side firms really have around this, that this is a non-risk weighted model. So businesses like central clearing, which are highly collateralized businesses, don't really benefit out of it. And the way it's not really getting into the detail of the model, but the real question here is all the gross notionals of the derivatives outstanding is one of the key components driving these exposures. So it's very essential for all sell-side firms to get to a stage where they can actually compress these trades, whether bilaterally or through a CCP. So the biggest challenge which obviously the interest rate swap market has is that you could really trade all kind of maturities because it's very bespoke. And what it really forces is that the netting opportunities are really restrictive. So one thing which obviously would happen as a response to this is there'll be more standardized maturities trading so that there are more compressions which can happen. Now the big challenge here is both the issuance market and the derivative market need to respond to it, because certain players would just do swaps to take certain positions on swaps. They can clearly move their trading activity to certain IMM dates. For other clients who are actually just hedging their long asset positions, are really dependent on the cash flows on those assets. So it's not really something which is changing now, but there's a high likelihood that it just forces people to actually trade certain fixed maturities, and the liquidity actually drives to certain points.
Okay.
I think worth adding to that, actually, to what Tushit just described, is that from my perspective, working for a client clearing provider, we're obviously, as Tushit's alluded to, we're hit quite significantly for this, because obviously we have to capitalise the margins, the initial margins that are being posted up at the CCPs as well. So it's a bit of a double whammy, really. This is why it's such a hot topic in the clearing space. I think it's worth understanding that obviously this is now being reported under, as per Basel requirements, as of January this year, being reported. So obviously it's sort of starting to change management decisions in terms of this leverage ratio number, and also the capital requirements. That actually only comes into effect in January 2018. And in the meantime, there is definitely a groundswell of opinion and an appetite to engage with Basel, with the BCBS, to try and actually tackle this topic and to try and deal with it in a more pragmatic way that makes the business of OTC client clearing far more commercially viable for the providers, and obviously more commercially appealing and easier to swallow from a buy-side user perspective. So we're of the view that this certain parts of this will hopefully evolve over the coming months and years before we hit the January 2018 timeline.
Okay, great. Moises, anything to add?
Not particularly on that piece on clearing. I mean, I guess nothing special. No, in general, the feedback that I can bring you is, of course, on the XVA side. I'm not an expert on clearing, but of course, clearing and any embedded cost has an implication on the XVA desk. In general, the thing that I am seeing, of course, is a greater emphasis on capital. Historically, many CVA desks, of course, start with trying to manage and immunize our traders from any counterparty risk embedded on a derivative. Later, we move into funding because we saw, of course, a clear link between an uncollateralized transaction hedged with a collateralized deal, hence triggering funding costs. Then we move into the FVA concept, etc. Now we are moving into the so famous KVA, capital valuation adjustment, because clearly trading OTC derivatives impose a lot of balance sheet costs, capital costs, mainly, let's say, at least the ones that we see the largest by far are the credit capital and the CVA capital. Then it makes complete sense to incorporate this additional VA into the decision-making process, into the pricing also of OTC derivatives. There was recently, I always mention, an article in Risk Magazine which was comparing the cost of each VA. And if I remember well, comparing vanilla transactions, I think it was a Euro IRS or a dollar IRS, they were concluding that roughly 50% of the cost coming from BAs is KVA. So it implies a massive transformation for an XVA desk, because it seems that you should, yes, be focusing on CVA and funding, but maybe you should spend most of your time, probably 50% or more, on the capital implications and the capital cost. Now, there are many hurdles from a technical point of view, from a system point of view, internally, how a bank should organize. Is an XVA desk the best place to immunize any capital cost associated to the derivatives or not? there are many open questions, but I think everybody agrees that the industry has to migrate and manage these risks, this extra cost on capital somehow. Now it also has implications for clients, for example, in terms of transparency, etc. So it's a very interesting moment. Yeah.
Okay, great. So just to get a sense from the audience about the background, maybe can I get a show of hands of people who are in banks? Okay, the majority. Within those banks, who is clearing already? Okay, small portion. How many have XVA desks or things like XVA desks, centers of excellence or something like that? Okay, okay, great. So relevant discussion, still relatively new, it seems like, for a large part of the audience. And we stepped into the discussion around how CVA and XVA desks are migrating based on the new regulations. Ian and Tushit, do you want to comment on that piece?
In terms of the migration.
Yeah, I mean, anything you'd add about anything you've seen, from the CVA desk side again. Not the focus is, for you is obviously the clearing side, but anything you've seen on any other comments based on that? It's not.
I mean, my experience is, obviously our dealings with our own CVA desks or XVA function at Commerzbank, we're definitely. They're engaging us with this more and more in terms of understanding what it means, comparing, getting a handle on the risk and the capital requirements of continuing with bilateral trading versus our execution desk sort of pricing cleared trades. So we're definitely moving forward, and that expertise is slowly evolving. And in some respects, that's what's driving from our execution desks. Obviously, I'm working on the clearing side, but I'm well aware that our execution desks are getting far more savvy and understanding of all these VAs that have to be taken into account, and certainly pricing between bilateral trades and versus cleared trades. That's certainly something that we are seeing in our in-house.
So maybe that sort of leads into on the subject of clearing, in terms of how sell-side firms are preparing for MiFID II from a clearing perspective.
Yeah, so MiFID II, I think we're very much, as you're probably getting a sense of this now, this panel, it's very much regulatory driven. MiFID II being another of those significant hurdles that everyone has got to contend with and get to grips with. Certainly, this is something, in my experience, hasn't necessarily been given the time and consideration it requires thus far. It's now, as was alluded to on the panel earlier, with the RTS for MiFID II being published yesterday, or over 2,000 pages of it, that the clock is ticking on that with regards to the obligation coming to force January 2017. My sense in all this is, clearly it's seen as a sell-side responsibility, but I feel very strongly that actually this is something that clearly affects all market participants, and even on the buy side, there's a really telling and significant need to understand what it means to each buy side entity and how they're going to manage their affairs, where they're going to sort of seek out liquidity in the future. Because obviously MiFID II, in a nutshell, to me, it's all about pre and post-trade transparency, and where I'm focused, it's clearly that it's that electronic trading platforms and organised trading facilities, OTFs, and I would suggest that from a buy-side perspective, they need to be there's a need to engage with various OTFs to understand which OTFs there's going to be a demand to actually get signed up to and actually seek liquidity on those platforms. So there's going to be a need to actually understand what it means for all market participants. And furthermore, my other sense in all this is we have one other big significant regulatory requirement out there, which is the BCBS IOSCO, which is bilateral margining. So that will in effect see that your bilateral portfolios are margined in the same way that they would be in a cleared world. Obviously there are specifics of whether your entity would be captured by that and in what timing. However, that is due to now sort of the firing gun starts on that in September next year. So you have BCBS IOSCO September next year, and you have MiFID II, really the hammer coming down in January 2017. And they're significant considerations for a number of market participants. And they're going to be really very much on top of each other. And furthermore, my experience of dealing in this general space is that you tend to get the same individuals and teams that are, whether they be working on clearing obligations with EMEA, on all everything that's covered by EMEA, or even with when you're going into sort of in the States with Dodd-Frank, etc. It tends to be the same people. So I would suggest that in that sense, there's a need for buy-side entities to actually structure their work such that there are, that they can meet these requirements as they come, as they're due, as it were. Which furthermore means, for example, getting your clearing operations, your clearing service, get that done and dusted and out of the way before, sort of the second half of next year is going to be really, we're going to be seeing a lot more focus on, like I say, those other regulations, and that's pretty much my view on it all.
Okay, so a lot of things coming down, the pipeline. Tushit, you talked about Basel III a little bit before, but maybe you can elaborate around the impact of the Basel III leverage rules in terms of cost, in terms of repricing, for clearing members. How is that impacting how they're passing on costs to their clients?
Yeah. So obviously, before, in an era pre-Basel III leverage ratio rules, the main drivers for all clearing members or clearing brokers were twofolds. One was the operational cost, and the other one were the default fund contributions one needs to make at the various CCPs. And the best way in terms of a pricing model to capture those costs were a standalone ticket fee on each trade cleared, and a certain percentage of initial margin on that client portfolio, which could be assumed as the best proxy for default fund contribution at the CCP. Having said that, this pricing model was not really sustainable after the leverage ratio rules came in, because the main driver for clearing members actually became the leverage ratio balance sheet. And the real thing which was driving is the gross notional of all the trades cleared by that clearing member, which basically is obviously forcing a lot of clearing members to actually change a pricing model wherein one could price based on the amount of notionals cleared rather than just purely on a risk-based item like IM. So it's more like a three-way model for certain banks wherein a ticket fee is charged to cover for the operational costs. You charge a percentage of initial margins at the CCP, which covers for any liquidity costs or costs of managing the default fund. And then the biggest component which is driving is kind of an asset fee, which is directly proportional to the amount of balance sheet used by the clearing member to actually clear that portfolio. Given this pricing, there's obviously a lot of incentive on the client side to actually have a portfolio which can be actually compressible. And that again drives to certain clients having portfolios which are still extremely efficient under the new pricing model, but certain clients need to actually see if there's any scope for positioning the portfolio in a way where a certain amount of gross notionals can be compressed or taken off so that they don't incur a lot of costs.
So do you find, in terms of being able to explain the costs to a client and the client saying, well, how can I minimize the costs? Is there a lot of those kind of discussions? Or?
I think one key service which is obviously standing out is the ability of the clearing members to explain how the end clients can actually benefit and what compression services a clearing member can provide. And obviously all the compression services at the OTC CCPs, especially CME and ICE, have been changing a lot in terms of the most elementary compression service which was available earlier was, in a client clearing context, was riskless compression, i.e. if you have exactly 2 offsetting trades, you can compress them. But given that clients are trading almost all maturities, that is not something which was really helping clients a lot. One thing which CCPs over time have done is they've said that if you can actually manage to have the same cash flows, and even if you have different fixed coupons, you can still compress it based on a certain guideline. So obviously CCPs are coming up with innovative ideas on how to compress those portfolios, and clearing members ideally are trying to pass on all those compression regimes back to the clients in order for them to actually bring down the gross notionals.
Okay.
I think something else to add to that, to what Tushit just described, is, for example, there are some CCPs who've got futures and an OTC portfolios. For some clients who may have portfolios at the exchange on the futures side, as well as on the OTC, the clearinghouse, there are cross-product margining opportunities, and that's another example of CCPs trying to come up with strategies and services that actually help to reduce those upfronts of capital requirements in terms of initial margin. And as Tushit just alluded to, where we are, the impact of initial margin it's a double whammy, in as much as the capital requirements on the back of that, they grow as well with your initial margin. So it's a big driver in the market.
Okay, that's interesting. So compression, cross margining, the innovation that's happening in that space. I guess I'm imagining from the clearing side, a lot of that's happening from the experience in the US. I would guess, is that kind of the case? Or?
I think, yeah, there's definitely given that it's a more, I wouldn't say mature, but it's further down the road than where we are under EMEA in Europe. There are obviously, you've got the likes of even CEFs, that's when it comes to MiFID II. That's going to be a useful pointer, certainly when we're coming to dealing with OTFs in Europe. That said, I think there is, it's not necessary if it's just whatever has been done before under Dodd-Frank is going to be extrapolated and used under EMEA. Because there are fundamental differences between each of those regulatory regimes. Mm-hmm. So it's still, I'd say Europe under EMEA is carving its own furrow as well.
Okay. So interesting, points in terms of clearing. So the discussion around XVA and the cost side of that. So Moises, what's the impact on clients, from an XVA desk perspective, in terms of clearing?
Well, again, I can bring feedback on what's the impact on clients while we try to add all the XVAs and price charge them and manage them. The issue is that if you opt not to clear, you have a non-collateralized transaction with a client, adding the capital component that I was mentioning, unfortunately, it reduces even more the transparency that clients would like to see. And it's not, I feel that banks are not keen to be transparent. The issue is, as I was explaining before, we were adding first the credit component, then the funding component. Now we are adding something that has a lot of uncertainties, which is a capital piece. I would assume also for clearing, regulation, which is one of the main topics of this panel discussion. If you have a 20-year IRS, in a strict sense, you have to kind of forecast what are going to be the change in regulation in the next few years, because you have to ensure that you charge enough to bear any balance sheet costs, any regulatory cost. So it has a lot of uncertainty. You need also to envision, look, yeah, my client closes a 20-year IRS. Is it realistic for me to think that it's going to hold to maturity? Clearly not. Many clients will unwind because these are trading positions, maybe some of them, or they hedge, but they revalue a few years later and unwind, etc. Then maybe it makes sense to reduce the cost, the balance sheet cost, to try to measure the behavior of my client regarding the potential unwind. So it becomes very tricky. So going back to your question, unfortunately, it reduces transparency from a pricing point of view. The law of one price is completely broken. I was chatting with a corporate in a seminar a month ago, and he was complaining about lack of transparency. I told him, well, he was in a conference on KVA. I told him, look what's happening here. It's going to be even less transparent. And he understood that it was not because banks are not keen to be transparent. It's because the problem that we have in front of us is very, very complex, and it has a lot of uncertainties. But that's a reality on which we live, unfortunately.
Mm-hmm. So in terms of the challenges that are faced with XVA desks, how they're evolving, I mean, given the fact that a lot of the audience, they're not at the point where they've got an XVA desk, they're at the point they might be clearing. Do you think it's do you think it's getting easier to set up an XVA desk? Is it getting, because all of the kinks are being worked out by the banks, or is it getting less?
Well, for those banks that do not have an XVA desk, I would assume they don't have a declared XVA desk, but I'm sure there is concern within their banks and senior management to manage the increased capital cost of linked to derivatives. So maybe you don't have centralized in one place management of credit, funding, and capital, but for sure you have a group of people that is trying to monitor at least the capital implications of the transactions that are closed, new deals, and existing portfolio. I doubt people is ignoring these because these are massive costs. So.
Yeah, I mean, certainly our experience, again, talking from what we're seeing on our execution desk, but yeah, in terms of managing the tail risk with the existing portfolio that is now significantly in a very different place to how it was judged previously before all the new regulations took effect. That is causing, that is the main focus, I'd say, quite frankly, ensuring that is being managed in an optimum sort of fashion. And yeah, I dare say that is taking a lot of entities' sort of focus in terms of just managing that existing portfolio and ensuring that it's being dealt with in an optimum fashion.
I think in the past the point is that the capital cost linked to derivatives was not probably as big as it is now. Now there is no choice, you have to manage it. And it's very prudent and logical. It sounds a little bit kind for some people, kind of nerdy, if you want to put that word, to have an XVA desk. But it's so natural to think about it because you're just trying to immunize your bank against a very significant cost that you will be facing, linked to capital, leverage ratio, liquidity cost, balance sheet usage, etc. And the philosophy at the end is the same. Why it end up on the CVA desk? Because the initial objective of the CVA desk was precisely to immunize the bank against any potential default. So I guess traders focus on trading and doing what they know to do, which is trading rates or FX or servicing clients, and then immunizing the bank against losses coming from the credit default side. Then funding came and people thought exactly in the same logic. Now capital is coming, and again, you have to bring a given return on equity or capital to your shareholders. So it is just natural that you need to protect that and immunize that return against potential capital use. It's as simple as that saying it. Now implementing it, of course, has lots of uncertainties and technical difficulties.
Mm-hmm. So we're coming to the point where we want to open up for Q&A, and there's a lot of things that that are there to be discussed, a lot of different subjects. So on the clearing side, we've talked about a lot of the different impacts there, the issues around reducing cost on the clearing side, being able to produce transparency. In some sense, it seems like a similar kind of theme through a lot of the pieces, right? So how do we manage the cost? How do we reduce the cost? How do we provide clarity to clients around those costs? Maybe just before we open to questions, or maybe just a sort of a question to the panel in terms of what's the future? What are the things to worry about? And I'm going to put those the wrong way. It'll be a bit more positive. What are the things we should be focused on over the next 6 months?
Next 6 months. Well, I would say from what, in my position where I sit, absolutely the thing to focus on would be the clearing obligation. This is something, obviously, if you're impacted by that. And from a regulatory perspective, I would be looking to get those requirements nailed down and sort of put to bed, as it were, so you can move on to, like I say, this, or certainly have a clearer line of sight when the bilateral margining and electronification of trading, i.e. MiFID II, start to come into play. That said, I think that's probably a given, and people with that's so near in the future that people understand that. But I think that where we sit, the next step is going to be people actually understanding that there are benefits of central clearing, and as it is here to stay, it's a question of trying to leverage those benefits and actually, understand what they are for a start, whether it be collateral management, the fact you're pretty much outsourcing that to your clearing broker, the fact that you're not managing a number of bilateral CSAs, so legal resources, is not necessarily freed up, but they don't have that burden. And understanding these opportunities and actually aligning the business to that, I think that's where the next opportunity is. And also things like how are you going to manage your bilateral portfolio for trades that cannot be cleared. I'm sure there will become a point where everyone wants to kind of channel the collateral management of those portfolios through their clearing broker in some shape or form.
Okay, so Ian, what do you? I'm saying, sorry, Tushit, I'm saying, what's your 6 month?
Nothing really on the 6 months, but what definitely is something to look at is how all the sell-side firms actually incorporate all the costs they are incurring, and would this actually make things more, as Moises earlier said, would it actually make things even less transparent? Maybe yes, because different sell-side firms are at a different stage of how they're pricing these costs in. And this could actually lead to a stage where certain people actually price in all the costs and actually price themselves out of the market, while certain people are too late and they also price themselves out of the market. So where exactly should be the price is something which is obviously a key thing. And given that central clearing is just around the corner, how exactly the ecosystem of cleared trades versus uncleared trades behave, given that uncleared margin is also around the corner. So we may end up having different ecosystems and different dynamics. And a very important thing for everyone is to understand is, if not mandated, is it better to actually do a cleared swap or an uncleared swap? Is it worth taking the risk, or is it worth capitalizing the risk? So I think given central clearing around the corner, we actually see different small subsets of ecosystems which would interact closely but will have their own dynamics.
I think it's an important point that there's a certain set of products that are quite active that will not likely ever be cleared, right? So for even though it's a painful thought, it's probably realistic to expect a world where you've got a mixture of cleared and uncleared, and choices sometimes. Moises, what are your thoughts?
Well, completely in line with the things that have been said. The biggest change is that now trading units require a place to not work as silos, independent silos. Now you cannot have one desk doing their thing, a group of guys just looking how to compress transactions and focus only on clearing. You need to put all this together in a coherent way, and decisions, trading decisions, management decisions need to be taken. I guess institutions are realizing that they have to be taken, taking different pieces from different silos, merging them to make them meaningful. It's not going to happen, of course, in 6 months. I have been saying also that it's a very complex problem, true, but also it's common sense. Few things can be done with common sense, well, again, adding a product, a business line, or discontinuing that, or entering into a given transaction now has to be measured on the lens of taking all the VAs, all the costs embedded, and of course, I guess the ultimate goal is to try to achieve a given return for your shareholders. Then everything is merging.
Okay, great. All right, so I think we're hitting our time limit here, so we'll open up for questions. If it's for a particular person on the panel, just make sure you address. Otherwise, no questions? I've got a question. So, one of the discussion. Oh, there is a question. Sorry, one in here.
I was just wondering that in the case of cleared trades, as per current regulation, a lot of the VAs, such as CVA, for example, can be excluded if the trade is cleared. I would imagine KVA for OTC, two main components being CVA and CCR default loss. So CVA is out, so CCR default loss basically that we are focusing on from a KVA perspective. So a lot of these add-ons and the transparency bit that we talked about, you think that will not be a worry if we move more and more towards clearing? Because the number of add-ons decrease as you move towards clearing, as you can see.
Yeah, well, it simplifies life because you don't have capital CV or credit capital implications. Yeah, but yeah, you still will have clients that are not capable for any reason to clear, or you might have products that maybe doesn't make sense to clear them. Again, the problem of clearing also on the costs associated to clearing are not only affecting when you close collateralized transactions. If you close a non-collateralized hedge, then of course you hedge with a collateralized transaction which might be cleared. Then you have to play rightly on the cost, the initial margin cost, which might be a VA that you have to pass to the client. So, but I agree. If you don't have an uncollateralized transaction involved, then it might simplify the VAs. Still, you have a few of them, yes.
Given that we've got less than 18 months until MiFID II comes into force, I'm just wondering from each of your perspectives of the banks, what are the key areas of focus? It's quite a broad set of regulations, and from my discussions with various people on the street, everyone has a very different point of view of the sorts of areas that they need to start deploying teams on and really start getting people off other regulatory areas and onto those areas of analysis. I'm just wondering what your points of view were.
Yeah, well, from my perspective, speaking purely from a sort of client clearing desk, I mean, our main challenge be over and beyond the standards, understanding which which let's say, just talking about OTFs here, from my perspective, that's our main focus. For example, which OTFs are we going to make a decision to connect to, and what does that mean? But that's a given. That's what everyone's going to do. I think there's an opportunity here for, when you've got certainty of trading, certainty of clearing, coming in, and the connectivity and the pipe work between OTFs and credit hubs and clearing houses and clearing brokers, etc., that requires a lot of focus to ensure that strategically you're actually making the optimum decision in a relatively, and you've got a very short space of time to go through this. And I think purely speak from a clearing desk perspective, it's that the credit hubs and how actually which options and which setup is going to be the optimum for you, beyond, like I say, the standard queries and decisions that everyone's going to have to make.
Any other comments? Or? No?
No.
Okay. Any other questions?
Perfectly timed, chaps. Perfect moderator. Thanks very much, Mr. Douglas. Thank you. And of course to your panel, Mr. Alvarez, Mr. Sen, and Mr. Morris. Appreciate it very much. So before I take my leave of you and ask you to avail yourselves of the networking reception drinks, just hope you enjoyed as much as I did the whistle-stop tour through the key or salient points in XVA and collateral and clearing. I think for a lot of these issues there isn't necessarily, which is often the case in finance, one solid answer to all of the issues that have been raised. Especially when it's uncleared. Right at the end we had a question about a lot of this goes away. Well, much of the material points go away one side clear through the CCP. I can worry less about some of these XVAs, but of course for the time being the issues they raise don't necessarily present or don't necessarily have one clear-cut solution. Take FVA for example, there's more than one way that banks are approaching it. I think for me personally the way forward, or the best practice approach would be to use judgment and a conservative approach and implement what you think is the right solution, and then make a case for it, whether it's to the external auditor or the regulator or to any of your peers. But quite a few of the issues that were raised today from Mr. Gregory's presentation and subsequently don't necessarily have one straight black and white answer for them. But that's the fun of the game, right? We also saw that collateral management, if it isn't already, is becoming quite an important part of a bank's overall balance sheet risk management infrastructure and procedure, and needs to, in some cases, for the larger banks, become quite a sophisticated operation, if only to optimize the balance sheet. We've got the issues being discussed here today with respect to centralized clearing and the XVAs, but also, of course, there's a regulatory impact on the regulatory requirement, and it becomes imperative to optimize the balance sheet from a number of perspectives. I mean, if I was a treasurer, as indeed I was in a past life, in a just a recent life, if I was a treasurer, I'm concerned with liquidity and Basel requirements for liquidity risk management and liquidity reporting. But from a wider perspective, collateral management also becomes has big implications for the balance sheet, and so optimizing the balance sheet requires a reasonably well-connected and well-joined-up collateral management function. So I hope all our insight and chat this afternoon was of value to you. I'll take my leave, as I said, bid you good evening, and enjoy the drinks. Thank you.